Do you think this is a market now exhibiting some fatigue?
Yeah, I think so. I mean, well, notwithstanding today's performance, it looks as though markets are enjoying a bit of a bounce, particularly emanating from the emerging markets and commodity type names. And it's difficult to get too enthusiastic about that. I mean, the dynamics that have prevailed, that have brought about their weakness, we think sort of still persist. I guess central banks' activity is catching a bit of a bid, but really, when it comes down to fundamentals and earnings quality, we just don't see it. And yes, central banks can ignite a bit of appetite, investment risk appetite in the short term, but we can't really see that prevailing. So probably thinking about fading some of this strength, selling into it as the market shows some of this fatigue that you mentioned.
When you look around the world, what do you look for that might lead you to become a little bit more optimistic about the longer run trend? I mean, is it China? Is it what's going on in America? What are you looking for that might make you move your view?
Well, I think China would be one of those factors, and in fact, we are feeling a bit cautious on our cautious view at the moment, in that there is some better data coming out of China, whether it's fixed asset investment or in the housing market. But really, that big overhang of leverage that clouds China's economic performance, we don't think goes away. Whether we can see actually the developed market central banks, such as the ECB's policies, turn into demand. We're seeing lots of supply responses, incentivising banks to lend, but whether that actually translates into it's the credit impulse, whether we can see banks lending pick up. We've seen banks European bank lending pick up from lows from the financial crisis, which is good for growth. But to kick on from here, we need bank lending to accelerate, and really that's showing some fatigue that's giving us some concerns.
When we did see some initial acceleration was in bank stocks on the back of the ECB, and investors looked at it and thought, well, this could be positive for the overall space. So if we are looking at an environment, and from banks to the commodity space, we've seen an acceleration there based on some central bank policies as well. If it's a fat and flat trade here, don't you need to chase some of these rallies in some of the sectors?
Yeah, I mean, that's a difficult game to play. You can cost clients money with sort of aggressive levels of turnover. But there are strategies that can be employed that make money in a volatile but non-trending.
Such as?
Well, the volatility spreads, the butterfly spreads, or there are ways you can sell options that make returns. There's sort of complex hedging trades, but you can sell options that make money in flat markets. If you get an extreme movement, then you get extreme losses. So there's a risk and reward in these positions.
And Ben, one move we saw following the ECB moves there was this rush into credit. A lot of optimism flowing back into perhaps credit could be the opportunity here. Yet you say that you are marginally underweight bonds. Why is that? Why are you not more optimistic about the ECB getting into the game here for investment grade?
Well, actually, we would agree with you on your point there, in that we're overweight credit, but we're underweight government bonds. So there is, there can be some confusion there. So sorry about that. But really, we don't think there's much money to be made in government bonds. I would expect a lot of people think that, but. We don't see a bloodbath in government bonds, because we don't see interest rates going up very much. But we do think there's a little bit of carry to be enjoyed in credit markets. But you can't escape volatility there either, I'm afraid.
Are government bonds just a good hedge these days still, when you've got volatile markets?
I think they are, and I think we are seeing in the press at large, and lots of people coming out saying, well, bonds are such low, government bonds yield so little that they are no longer the hedge that they were, and I really just don't think that stacks up. The evidence suggests they are as good a diversifier as they've been. Empirically, that stacks up. So we're underweight, because our core view is that the economic scenario isn't one that is a prolonged recession. We might have a brush up against the recession, so in that environment, stocks perform. But the conviction levels aren't at that level that we render government bonds a zero weight.